Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, April 1st, 2020. What I'd like to do is just a quick look at the markets. I already sent an update out this morning. What you have here are some levels to watch on ES, the S&P 500 E-mini futures, as well as NQ, and then we'll look at SPY and QQQ, of course, as well. So you have these pretty clean downtrend lines right here to watch. And then you have that support at 2460. It's a level that's been on this chart for a while. It was on it should have been on the charts last night. That is pretty decent support. We came a hair above it there, and we're not there yet. Trend lines, if we pop the trend lines, you can see we have pretty significant resistance there at 2504, give or take, right there. And so if they pop the trend line, they're going to still need to take out that 2504-ish level. And if so, you're looking possibly, potentially, I should say, at a bounce up there at about 2550 or so. And that would be, at this point in time, my maximum upside target if we do pop it. And I wanted to, again, do the video to just kind of reiterate my thoughts. You have to define your trading style. If you're an active trader, nimble trader, you could certainly try to game, a bounce there, bounce, break out above that level. But I think for the time being, I really like the short entries we have recently on some of those index ETFs, and my preference right now for as far as swing traders, less active traders, just hold out. I think, like I said, it's hard to say whether we'll bounce or not, but I do favor more downside this week, and that's it. Sometimes you have to look at the bigger picture. So if they pop it, I suspect they won't even run up that high. I think the timing on those shorts were good from both a technical and a fundamental perspective. Things, like I said, they're not getting better; they're getting worse from a fundamental perspective. And I want to talk on a little bit. I'll get into this video just some of the risks with these ETFs and the reason why I used the 2-time leverage ETFs this time around instead of the 3-time. Or I should say non-leverage on QQQ, but I'm going to go over some of the different options for you as well. So that's it. It's a matter of most, and I mean, of course, anything is possible, but at most I'd be looking at that. But I'm leaning towards more downside here this week to at least that next target. And that's a pretty nice drop there to about 2386 if we get there. And again, I'll give you some levels on SPY in a minute, and QQ, that's about 4% down from where we are right now. Again, that's and you can watch this trend line too. If it sets up down here, we can extend it. Maybe we hit that level. Maybe there's a catalyst for a bounce. Technically, we can make a case and might reverse it there. But that's it. I don't see a lot of, there's other micro levels within here. You could come into play about 24.15. But let's look at NQ real quick. Let's do that. All right, NQ, there it is. Now NQ, and this is why I like to watch both of these, even if trading only one. And I do have positions in both. I like ES and NQ right now. As one may outperform the other. I think at some point we might start to see tech leading to or catching up, or at least leading, not catching up, but closing the gap, I should say, to the downside. Right now, it's been more about SPY because the banks are getting beat up bad, and travel companies, travel leisure, all the other sectors that have a higher weighting in the S&P 500. But you can see there's that trend line posted this morning, and NQ had better support here. So this is what happened. Where I showed you ES was a little shy, NQ all morning long has bounced around that 75-40-ish level right there. Actually all morning and all night and into all morning. These are 60-minute candles. And took out the trend line, but like I said, right above it you have 76.20.21. So there's what I call your BOD level, benefit of the doubt. The trend line certainly sparks some buying. Traders watch these things, but if they're blind to the levels in front of them, like I said, not the most high probability entry when you have a trend line there. And ES had not yet taken out the trend line, so you had a trend line breakout on NQ, but again, resistance just above makes it greatly increases the chance that breakout can fail. And if so, you need to watch this 75-40-ish level. That's it. I think if that goes, and that comparable level I gave you on ES takes us down here to about 73.74. What would that be? I'm going to have to start my line up here, and I'll stop a little shy. So I don't move that trend line. That's about another 3.5% or so drop from where we're at right now to get down to that next target. So that kind of gives you an idea of what I'm looking for, and probably happen if not today, by tomorrow, quite possibly today, even though we're already down, right now 2.5% here on the futures. We'll get to SPY and QQQ in a second. Let me just show you RTY. RTY, the small caps got beat up last night, and they hit lock limit down. That 5% lock limit that the futures hit in the Globex section. That's the around the clock trading. So you can see they pinned it down here at the 5% lock limit down all night on the small caps, and we're still right there at that number now. But once a regular session starts, they lift that. The 5% up or down lock limit is only for the Globex section outside of regular trading hours. When regular trading hours 9:30 to 4 begin, then the indexes are subject to the trading halts, the circuit breakers, and that is based off the S&P 500. So when the S&P 500 trips the breakers, everything shuts down. Whatever, I don't know if we're going to hit that today or not. I don't see anything's possible. But yeah, I just want to show you the levels too. And let me tighten this trend line, clean it up a little for you small cap traders. Right there's the downtrend line. Nope, I need to take this one now and move that. I'm having a hard time getting it right where I want it. There it is. Okay, right about there. So you have the small caps are also, just coincidentally, that 5% lock limit down came in right around this support level. You can see near that previous reaction low. So we'll call it about 1090 or so. And we're above it now. We're holding support. So, buyers do what they do. They come in and buy support. And like I said, we bounced. There's the upside potential target right there, 1116. That would provide an objective entry, especially if SPY and ES and NQ, I should say, hit those same comparable upside bounce targets. That's about 2% above. So to me, it's more of a matter of picking up nickels in front of a steamroller, especially for traders that aren't active and nimble, trying to get that, bounce that may be 2% or so here, versus a downside drop of about 3.5% or so to the next downside target, about 1056. Okay, now onto the index ETFs. This one was like hitting the easy button yesterday. Just watch that. SPY was working up, and QQQ, these 60-minute bearish rising wedges, negative divergence, everything else. Then you had a breakdown that didn't just limp through there. You had a big impulsive candle, parked it right on support, and then boom, gap down. So like I said, that was a very objective short entry, and based on the divergences, everything else, it said that we'd get more than that was the start of something more. And so here we are down, better than 3% right now on the S&P 500. Gap down below. Remember, that was the next target, 250, 51. So I love to see this kind of stuff. Sorry if I speak, and I do understand that. I'm an equal opportunity trader. I'm just as comfortable shorting as going long, and I know a lot of people don't like the market falling, and I don't take pleasure in other people's misery, but I'm just saying from a technical perspective, and someone that loves the charts, this is a good thing to see. Why? Because that was a big support level. We gap below it. And so what that does, it denies more shorts that didn't short yesterday, question the breakdown, maybe question we close at support, or believe that, because we're in an uptrend, you don't want to short. God, if I had a nickel for every time I've heard over the years, a trend is your friend, blah, blah, blah. You get killed in a market like this if you're trending. When do you determine when the market was no longer in an uptrend? Do you wait, till it's down 35%? Do you wait till it's down 20%, 10%, and then what do? Do you go short here, here, here? That's what a trend trader does. I'm talking the longer term picture in SPY. And then at what point did they cover their shorts and go long if they started to short here? 5% up, 10% up, 20% up. That's so you have to almost anticipate these moves. And again, that's my trading style. It doesn't always work, but you got to get in front of trades and your reversals, inflection points before they happen, or shortly thereafter. Anyways, so now we're looking at what's probably the start of a new downtrend. And where I was going with that, the fact we gap below that support is even better, because just from a technical perspective, it's denied more shorts and objective entry. They probably don't want to chase a 3.5% drop, and so the fewer, the more alone we are on this trade, the better off we are. So as I said, you don't want you don't want to short a stock or a index or sector that has heavy short interest, because it tends to put somewhat of a floor in there. And it also, what it does is it traps longs. It gives them that, punch in the stomach kind of feel right now. They were, maybe they didn't buy right here, but they thought it was safe to get back in the water here, and they bought, and now all of a sudden they're back underwater. And so it's where you get those panic sell-offs, and we could get a nice drop here. So I'm still favoring more downside. And let's see, I'll give you targets there. Coming up, there's one support level right there. So and that kind of aligns with where we're at this morning in the futures. That lines almost perfectly with that same level I gave you in the beginning on ES. And based on the divergence, everything else, like I said, I forget about the very near-term direction. I think it's best to just sit tight right now and ride out counter trend bounces. If we do bounce, and again, I don't expect this much, and it could certainly go more, but that would be my maximum bounce target back there. Looking for maybe even a gap backfill. Today's gap, but again, I doubt that'll happen based on everything I just talked about, the nature of how this reversal has happened. I don't think it's going to give anyone the opportunity, shorts to get in on a backfill the gap, or longs to get out with minimal damage on a backfill the gap. And again, if I'm wrong, we'll play it, trade it appropriately. Maybe we get there, and maybe I'll say, okay, well, we got there. Now let's add a new short, or we'll see. On the official trade, nothing's really changed. I'll at some point I'll lower the stop, and I can tell you, remember, these are just suggestions. You're profitable on this one. Once again, we gap down below that T1, and just like SPY, this is what I love to see on this kind of trade. We gap below that very well. That was a very significant support level here, 185.50. That was our target when we shorted it here. Hit it once. It was there were a lot of reactions along the way. It was the bottom of this big gap here that makes that level very technically significant, and the fact that we gap down below it now opens the door. Unless this market can pop back above there and solidly recover it soon, it opens the door for a move down to T2, which I think will be hit today, quite likely. And if not today, again sometime this week. We only have a few trading days left, and so again, define your trading style. I still think all these targets have a very decent chance of being hit, and possibly more. I may extend this trade. We'll see how it plays out. But as of now, those are the targets on the QQQ trade. And I'm going to just show you a few other things, and we'll wrap this video and get out to you. I'm looking, and I'll continue to do this, and I solicit feedback from you guys, members of the site, gold and silver members. Let me know companies that you think might stand out, especially on the long side. I wouldn't mind. Not crazy about going long, especially stocks that are indexed, meaning they're in the S&P 500 or the Russell 2000 small cap index or the mid cap index, because those stocks tend to get sold indiscriminately when there's a lot of selling pressure, when there's a lot of money redemptions coming out of the ETFs and the mutual funds that track those sectors. However, so I like to find the stocks that fly under the radar. I'm going to give you one. I've already mentioned this one recently, but it's one that I mentioned having a position, and I just added to that today, even though the stock is up. I'll get to that in a second. Well, we can start there. Why not? And then I'll give you the two other ideas that might perform. MNK, Mallinckrodt, is it's a small biotech. Biotech. Let me give you the definition here and tell you what's going on. Here's the chart. Let me just start there first and foremost. Show you the chart is quite constructive. Now it's a low price, aggressive stock, high risk, but again, it's they're showing it here as a drug manufacturer in the specialty and generic arena. But what you have is a big divergent low, positive divergence right here at the low. So that's the technical basis for this trade. It's been moving up despite weak market. Well, the market bounced recently. A lot of things did, but they've got some stuff working, and there's a lot of companies I'm sure out there doing this, working on potential, whether they're not outright cures or things that might help with the coronavirus. And what happens, it can really move the needle on these small companies. Now, again, I cannot overstate or emphasize the risk enough when trading a low price stock like this. Things can go the other way, and you can be wiped out in these. So again, do what you want. If it's not your cup of tea, if you're not an aggressive trader, don't consider this. And I wouldn't put much more than Vegas money into something like this. But maybe a little bit more than that. This company's been around for a while. We've traded on the site over the years. Well, let me show you what's going on here. And then technically you can see we have a downtrend line here. My first target there is about 267. and potentially I think it can go up here no problem to these two if we continue to see some bullish developments going on here fundamentally and technically. So that's about 20% to that next target, about 82% there, and about 175 or so percent if we get to that 621 level. And what they're doing is they're working in conjunction with this other company and they just received clearance from Health Canada to start a pilot trial of high-dose inhaled nitric oxide therapy for COVID-19 infection and associated lung conditions. You can read about it anytime you want to. You get a good source. I love Yahoo Finance is easy. If you just type in a Google search or any web search, type in a symbol of a stock like MNK space Yahoo or Yahoo space MNK. The first hit will be Yahoo Finance. You can go in there and then you get to the, bring you in there. This is what Yahoo Finance looks like. And when you go to summary down here, it'll give you the news headlines right there. So that's one way. Of course, you can do more extensive Google searches on news. You can look at the company's profile. What do they do? What are they all about? Right there, it'll give you a description. And again, it's just one of many trade ideas. Not really what usually makes the cut for an official trade. Maybe trade ideas have been relatively light because I'm focused on a few things like the index, corporate investment grade corporate bonds. We have gold, so we have a handful of trades, but not really heavy. So this is one idea if you're looking. And the other ones, I saw a commercial the other day on TV. I can't remember who it was, if it was Papa John's or someone else, Domino's. I don't think it was Domino's, but it doesn't matter. It brought a very good point. Here we are. Most people are doing the right, not all, but most people are doing the right thing, social distancing. That means staying at home with your families. I'm sure everywhere else it's like this. The kids are home from school. And, we eat out a lot. We like to go out to restaurants or order in a lot, and of course now that you have to question that this coronavirus is serious. It's real. It's really bad news if you get it. So you have to think twice on any prepared food. Even if the drive-thru at McDonald's is open, you're getting warm food that's being touched. The hamburger, the buns, everything. The box of French fries come in. They might not touch your fries, but they're going to grab the box, and you're going to grab it anyway. So where I'm going with this is the commercial was for pizza. It's a good point. A pizza is baked in an oven at 400, 450, something super hot. Comes out on that little big spatula pan, gets slid into a box, never gets touched by hands. So I took a look today, and you can see that the pizza stocks are certainly holding in there. Here's Papa John's. It got thrown out like everything. Baby gets thrown out with the bathwater, got beat down in that first drop. But you can see this is called relative strength. It's up today. It's been rallying. The chart looks pretty good. It had this flush out move down below that support, that 4. These are levels I've had on. I haven't even updated this chart really before this video. I pulled up my chart. These are old lines I had on Papa John's before. I haven't even looked at this stock in a while. And you can see, I would have updated here. We had a trend line there. That was a little price channel. We broke down. And this was the market meltdown. Everything got taken down. So here's my point. Look, as long as we're sequestered in our homes, it's tough. Most people don't even want to go to the grocery stores. The grocery stores that have delivery delivery services, like here in Florida, Publix is our big chain. My wife tried to do that the other day, and they said she told me 15 minutes building a shopping list, and then went to submit the order, and they said try back later. We're too busy. So it was a waste of time. They wouldn't even take orders. They're so busy. So my point is, this is going to be a convenient thing for people for the foreseeable future. It's safe, as long as you don't touch the cardboard box or wash your hands afterwards. That's one. So enough. I'm just talking fundamentals here. Technically, now look, unfortunately, I can't make a case to buy right here because we're at resistance 54.31. Again, you can see I've had this trend line on. I created this trend line back in November of 2019. And I haven't touched it, and it's acted as continued to act as support and resistance. It was resistance, resistance, resistance. Then we broke resistance. Once resistance is broken, and it was all back here, it was support, support. Once resistance is broken, boom, that was a breakout, and it rallied up. Then it fell back. It tested that level again, tested it for a while, and then the bottom fell out. Rallied back up. This is what I call a momentum fueled overshoot. We had a near vertical run. God, I would have loved to bought this stock down here at the low at 28.56. I wish I would have seen that commercial that prompted me to, kind of look at the pizza stocks. I wish I would have saw it earlier. 100% return. The stock exactly doubled from that point, and that's what you call momentum fueled overshoot. You had a near vertical launch, and we overshot it. But that to me is it respected that level because it shot right back down. So there we are. Here's the bottom line. What am I saying? Well, where to buy it? Well, I think if it pops above there, remember if the market melts down, because this one, as I imagine it is a component within maybe the S&P 500. I'll have to check. Yeah, it is. No, I'm not sure. I'll have to check on that. Or in the NASDAQ 100, don't know. Or maybe mid cap. I don't even know how big it is. There's a potential trend line and a breakout point if it can pop much above that 54.31. Next target would be up here. And then, the longer this continues, again, I think it favors these pizza companies. People have to eat, and they're going to run out of food in their houses, and the grocery stores are still slim pickings, especially in big metropolis, type areas. That's it. I was going to add something else. Okay, those are potential levels, and like everything, you don't fall in love with it. Use a stop if you take it, and again, those aren't hard targets, but those are potential targets. And I haven't updated this line in a while. Let me drag that line a little lower and give you a number for it. That would be the next target there, about 60.50 right there, and then the one after that would be about a little over 66, and then maximum right there would be about 70 right now. Round that off to a nice round number. And the other one, of course, is Domino's. Domino's is DPZ, that's right. And this one's down today, but again, look at this stock trading near all-time highs right there. Papa John's, we all know, had a big mess. Papa John himself made some racist comments and lost contracts with the NFL and all this other stuff, and I think had to step down. So that's why Papa John's is more of a beat down stock, but maybe there's some value there. People tend to forget about that stuff after a while. So Papa John's look pretty good. Domino's, I can't make a case until it pulls back here to 298.73. Doesn't mean it's going to get there. We'll call that 299, but you have uptrend line support plus price support. We'll call that 300. We'll round it off, make a round number. Looks objective there with a stop and or down to that uptrend line with a stop somewhat below it. And again, I have to say this. I believe we're in a bear market. I think we re-entered our shorts. We were mostly long and bullish the last couple of weeks when we should have been short coming into that, and now short again. And I'm viewing this right now longer term. I have no intention for the official trades to cover those swing shorts anytime soon. We could get another leg down in the bear market here, and where I'm going with that is technicals can be overridden, especially if we get in that meltdown type selling right here. Papa John's was up there at all-time highs. I'm sorry, Domino's, and dropped 26% because it doesn't matter how many pies people are ordering. They can be selling all the pizzas in the world, and people, if the stock market's plunging, and the algos and the machines are hitting sell, and mutual funds and hedge funds and pension plans are hitting, having to cut their losses, and their margin calls are hitting, everything gets sold. So I just want to point that out, that I'm making a fundamental case, but the best of stocks can be overwhelmed in a bear market and a vicious sell-off due to forced selling, forced liquidation, panic selling, and stuff like that. So let's just say I'm cautiously bullish on these, if that makes sense for you. And again, I welcome other ideas. There's got to be a lot of stuff out there. Healthcare stocks, biotechs, drug manufacturers are some of those, but you got to, like I said, you have to be careful with that. Like the example, again, somebody mentioned a few weeks back, 3M, and they make some of those masks, but look where the stock is. And I made this comment, and I didn't do the due diligence, but I told you have to look at 3M's a huge diversified industrial company, and the respiratory masks are what part of their product profit line or profit potential are their total product line. If it's a very small fraction of their sales, even if they're flying off the shelves, what is their manufacturing capacity? How many can they produce? We know this, you can't price gouge in this day and age, and if God forbid you try to do it now with coronavirus price increase, you're going to be demonized. So these big companies aren't going to do that, even though if we didn't, in a perfect world, 3M could quadruple their price and they'd still sell those masks. But they can't do that. So therefore, if they can only make so many and they can only charge so much, it may not move the needle, and you can see that. And the company is still near 52-week lows, although, again, somebody asked about that. So I said, you can look at pure play mass companies, but again, it comes back to what is their profit potential. And even then, there's talks now, the government using wartime acts to come in and actually just outright take over some of these companies, raid warehouses, take supplies that are being stockpiled for the better of the country. So you got to kind of really know, okay, who's gonna truly profit and prosper from this, not just who has some products that are being used right now, like 3M. That's why I'm using that example there. And I can't make a strong case to buy it based on the chart either. We had the potential there for divergent low, but they burned through that. All right, so I don't want to talk all day long, but if you have a company that you think might be benefit from this, or even a short, I'll look at shorts. I'm trying to find a few longs here because I do understand a lot of people don't short. And they don't know how, and that's one reason when I added the semiconductor short trade the other day. We're almost to the first target now. I went with SSG, and you guys, if you're a subscriber to the site, you notice in the past I've added SOXX, and it's up more, 3-time leverage. Why go with 2 times when you can go 3 times? Well, I'll tell you. One of the reasons is the decay. As I mentioned, if we get if we grind our way up here, let's say I do extend this trade to T3 even more, because we hold this as a trend trade, and it works out like this. And again, you can see this on the FAQ page of the site. It's under Resources in the top menu of the page. Go under the FAQ sections, and then under ETF related questions, there's one that talks about decay. And so if we did this, great. That's when you want to be an XOXS, which is the 3-time leverage semi. This thing only has 2-time leverage. However, where you get chopped up, if it takes a while, we grind around, pull back here, then go up here. The day-to-day up and down closes, when you see a lot of green and red candles, this is when you do better by holding a 2-time and even a 3-time leverage, where that 2 or 3-time leverage works in your favor. And again, I've explained it many times over the years, and the math is explained in that FAQ page. If you would have held SOXL, the 3-time long, during that period when this one went up that much, you would have had a better than 300% return, and in this one you probably would have had better than a 200% return. It's these unidirectional, I call them rips and dips, where the leverage works in your favor, but where you get chopped to pieces is this. This is not good. This is when the decay happens right here. This is a great example of when you do not want to hold leverage ETFs. That's where the decay happens, and again, it's explained in there. So that's what, and so what I did is, look, I think things will happen quick. That's how bear markets happen. So I think we'll get up there pretty quick if this trade plays out the way I think we do. So why didn't I use SOXS? Well, the other day, and I don't know which one it was, I got a memo from one of my brokers that they sent out, and it was one of the 3-time leverage ETFs, I believe, maybe SQQQ, TQQQ. It was the long and short counterparts. Maybe it was SPXL. I'm not sure. And it might even have been a 2-time leverage one. It could have been. But here's what the memo said. If I could find it, great, but I can't. What it said is, for the next day going forward, or that day that was coming up, they sent it out. They're reducing their leverage from 300% to 150%. See, what happens is these leverage ETFs, there's some tricky, there's some financial finagling in there, in other words, to track a sector and then leverage it up. They're not just, putting these ETFs in buying SPY in a margin account. They're using derivatives and things like that to increase the leverage. In these volatile markets, things start to break. And so what they did that day is they cut their leverage in half. So now here, think about it this way. Let's just say it was SPXL and SPXS, which are the 2-time and 3-time short S&P 500 ETFs. If it were those two, now let's just say right here, you were holding SPSX. Here, I'll do SPXL. Let me just try that one. Okay, so you were holding it right here, and the thing was really down. You lost a lot that day. It was a big drop. Looks like from where we closed, looks like you lost 8-9% on your money. and therefore that's a booked gain, or at least a realized gain, not booked, realized gain. And then the next day, let's say that memo went out the next day. Well, guess what, guys? For tomorrow, we're going to reduce the leverage to instead of 3 times what the S&P does up or down, we're going to reduce it to 1.5 times. So instead of profiting to the tune that next day of 27% or 28% right there, they cut your returns in half. And so to me, that is dangerous. That's bad news. You don't want to be in something like this, because the more leverage they use, the more they're going to have to, the more the chance that they may break. And they had to fix something with that, because they square those positions away at the end of the day on these ETFs. So I just want to say that there's risk in everything you trade in the stock market, but the risk factor is magnified with the amount of leverage an instrument it takes. You look at some of the mortgage REITs, they've blown up. They're down 70-80%. They buy mortgage-backed bonds and they juice up the returns. They pass along that interest. People have been buying them for a long time, chasing yield in this market, and they enhance the yield with leverage, and a lot of those have now blown up where you're never going to recover, at least not anytime soon. And it's going to take years, if not a lifetime or more, to recover the losses in some of those because they use leverage. So you need to know what you're trading. And although, yes, is there risk in SSG because it's leverage? Yes, but it's less than the 3 times leverage ETF. So I just want to kind of get that stuff out to you guys. It tracks pretty well. And why do I use these? Well, I could have just said, you can short SXD or SMH or SOXX. Those are non-leverage ETFs. But the thing is, a lot of you don't have margin accounts. You either have a cash brokerage account or an IRA. Let's say you have an IRA. It's $1 million IRA you've been building up for years, and you have a lot of blue chips that you're going to take with you to the grave. You have Apple that you've had forever and it's treated you well, so you don't want to sell Apple, but yet you want to hedge up. Well, you can't short you can't short in an IRA. You cannot short individual stocks or ETFs. So therefore, had I added SOXX as a short trade, you couldn't short it. Now QID I did add as a short trade, but there's a lot of options. That's what I'm going to go through right here for you guys. QID is the short, I'm sorry, that's the one-time non-leveraged NASDAQ 100 tracking ETF, very liquid. And then you have other options. You can go with here, PSQ. That's one-time non-leveraged. So there's one option for you. You can go, if you're shorting, let's talk about shorting, QID. That's 2-time leveraged. So you're upping leverage at 200%. Its counterpart is QLD, 2 times long. And then you have SQQQ, which is 3 times short, 300% leverage, and its counterpart TQQQ. So these are your options. Now, what is the benefit of maybe using QID over PSQ in an IRA? For the example I just said, whatever your number is, whether it's $1 million, 10 million, or $10,000 or $1,000, doesn't matter. In this day and age, with commission-free trades, you can diversify a $1,000 portfolio by buying in a few shares of various stocks and ETFs. But where I was going with this, so let's say you have that. We'll use a round number, 100,000, and you're in, 80,000 of it is invested, and that's in your long-term stuff. You have individual stocks, mutual funds, bonds, gold, other things. Okay, so you've got 20,000 there in cash to do something with, and you want to hedge up. So if you buy $20,000 of PSQ, that's the one-time short. Or we'll even talk S&P 500, SH, which is a one-time short. Well, you've now effectively hedged $20,000 of your long positions, assuming that they're index-related stocks, stocks that are in the index, major indexes. So that would be a hedge of $20,000 against maybe $80,000 the other. So you're partially hedged. However, you could also turn around and buy, the same 20,000 of SDS, because it's 2 times leverage, so now you're hedged effectively a $40,000 hedge against your positions. Or you maybe only buy $10,000 of SDS, and this is the option I like in IRAs. It leaves you some dry powder in cash. So you bought 10,000 SDS, but you've effectively shorted a $20,000 short position against the markets. Or you want to spice that up even more. I already talked about the risk, so be careful of that. But SPXS is a 3-time leverage S&P 500 ETF. And so whereas the S&P 500 is down a little better than 3%, this one, as it should be, is up better than 9%. Again, there are risks when you go into using the higher leverage, but it is also giving you that freed up, whether you don't have enough cash to fully hedge, or you want to leave some dry powder. You want to diversify of that, let's say again, that $20,000 of your $100,000 portfolio. That's your play money or hedge money to hedge up. So maybe you go with some of this or STS. Probably that's be my pick right now of the two. Again, for a swing trade, just because less risk, less leverage. The semis, you could do the SSG that we have, because I think the semiconductor sector is going to start to outperform to the downside here in the coming months here. This is not just a near term this week call. I'm talking months out. I think the semiconductor sector probably put in a major top, and then there's other things out there as well. So crude oil, you name it, gold, all these things you can leverage up, and you can short as well in an IRA by purchasing these. Because remember, to short the semiconductor sectors, you don't short SSG, you buy it, you go long, but there, it is effectively a short instrument. It is shorting the semiconductor, so you're going to profit when they go down. Okay, guys, that's it. I just want to kind of get all those things out there to you, some alternative ideas like I showed you, and I'll be looking for more of those. So like I said, if you see those, post them under the comments section. I can't catch them all. I try to go back and answer a lot of the questions, as many as I can. So if I miss something, just post it under one of the newer posts, and I'll try to eventually catch up with everything. It's been, as you can imagine, last few weeks have been very, very busy. All right, guys, we'll wrap it up here. This is Randy Finney with Right Side of the Chart. Best of luck in your trades.